Hey, what's up, guys? It's Corey here with Dapper Dollars. Today we're going to talk about the 5 ways that you can make money in a downtrending stock market. You ready? Let's get started. So, this channel is all about using the online income opportunities we have with Merch by Amazon and Etsy to build our passive income online, invest this income in things like the stock market and real estate. And if that sounds like something you're interested in, like and subscribe, and let's get started. So, you might have noticed that right now in 2021, it has been a little bit of a rough time, especially for the innovation stocks that we're invested in, and mostly the growth stocks that we're invested in. So right now I have stock in Amethyst, Vuzix, Hyliion, and Palantir. And all of these are innovation plays, and if you haven't noticed, all of them are down right now. I'm almost back down to where I started at the beginning or middle of, I think, 2020. So it's been a pretty rough time. You know, went all the way up to 18,000, and then the last month it's come down almost $8,000. So what can we actually do? All of these losses technically are on paper. However, it is difficult as an investor to see that your investments are going down to such a low valuation. But again, all of this is on paper. I have not realized any of these losses. Technically, my money is still basically in a state of flux, and it could be worth more in the future where I could sell, or it could be worth less if I chose to sell now. So right now, let's all just take solace in the fact that this is not a realized loss yet, and we have the complete possibility of this all turning around and making more money in the future, or potentially even more money in the future if we hold on to these investments. Because if you're anything like me, if you follow this channel, you know that I am a buy and hold investor first and foremost. I do not like to trade in and out of stocks. I did get into swing trading recently, but I mean, obviously in this market, it's not the best thing to do. So anyway, let's talk about the 5 ways that we can make money in a downtrending market. You can discern whether or not these are right for you in this current situation, but let's make sure that you have the knowledge to at least make these decisions for yourself. So the 5 ways are shorting stocks, buying negative or inverse ETFs, getting into the assets that are more reliable and the currencies that are stable, the dividend stocks, and trading stock options. So there are some of these that require us to trade to sell our stocks now, and these would likely be more advantageous if you were someone who could definitely see a downturn coming in the future and you were able to sell at the top. Whereas right now we're in the middle of a downturn, or at least hopefully at the bottom of a downturn, and we're likely going to see stocks come back, and we don't want to sell out at the bottom and realize a loss. So for the stocks that actually require you to have for the strategies that require you to have a outlook into the future and be prepared for something, let's talk about what's going to actually require you to sell your stocks in order to prepare for a downtrend that could happen in the future. And again, this is just to prepare. This is likely not a great strategy for you to do now, but this will be a great way for you to prepare in the future if you do see a downturn coming like this again. So the first one is buying dividend stocks. So selling your current investment and buying dividend stocks. This is a great way to hedge against the risk that could come against your stock market portfolio, because you're going to be getting into dividend stocks, which are likely the higher value stocks that are more stable companies that are also paying you dividends. So you're able to make money while you're allowing your investment itself, the principal of your investment, to remain stable and secure. So this is great because you're getting to at least make some money on your money, and you're not losing money to inflation and things like that. But at the same time, you did have to sell your stocks, and you're going to eventually have to sell out of these stocks as well again if you want to get back into growth stocks in the future. So whenever you're in this type of situation, you really need to weigh whether or not this is going to be a permanent move, or if this is an intelligent financial decision for you to either realize capital gains or losses on your taxes. So that is one potential way to move forward, which is the dividend investing. And then there is also the inverse ETFs that you could get invested in. Again, this requires you to sell your stocks, because you would have to then transfer them into an inverse ETF. And this is a hedge against what could be a downturn in the market. So an ETF is a overall index fund like the NASDAQ, the Dow Jones, the S&P 500, and these are tracking the growth of a stock market. However, the growth of a stock market is the hopeful trajectory up in value of the stock market. With the inverse ETF, it is exactly as it sounds. You are now planning for the downturn of the market. So, as the name implies, you would do well in an inverse ETF if the S&P 500, NASDAQ, or the Dow Jones were to take a sharp downturn or a gradual downturn. You would make gains as it went down. This is a great way to hedge against the possible downturn that could be coming up in the future. You would make money throughout this scenario, and you would not have to lose any of your principal. You would add to the principal that you have in your account. But again, this requires you to realize either a gain or a loss by selling your stock. So it is really not one of those things that you really want to do unless you're an active trader and not just a long-term investor. An active trader is someone who is more invested in the actual day-to-day management of your stock market portfolio. Most of us who are long-term investors do look at our stock market portfolio every day. However, we are not making trades every day. So that is the main difference between an active and a long-term investor. A long-term investor basically just looks at their stocks every day, whereas an active trader is actively moving their stocks every day or every week and making those decisions for themselves. And then there is the adjustment to the stable assets and currencies. This again requires you to sell your stocks, but you are putting them into a very stable environment. Now, with the stable currencies that you could transfer your stocks into, the Swiss franc and the Japanese yen are the two most stable currencies out there. So if you were to liquidate your stocks, realize a gain or a loss, and then plug that money into either of those two currencies, you are more than likely going to retain the value of your stock. You are going to not have to lose any money to inflation. However, you are also not going to make any gains on these on the money that you make because you are putting them basically into a currency. And since these are the most stable currencies, you're not going to see much of a move up or down. You're just going to keep your money at the same place in a very stable situation. And there is also the route of going towards commodities. Now, right now in 2021, we're seeing a really big move to commodities from the innovation stocks that we're in, like the Amethyst, the Vuzix, the Hylions. We're seeing a move from those innovation stocks into commodities. And that is because there is a massive pent-up demand in the market right now. So there was not hardly anything going on as far as industrial or labor in 2020. But once 2021 opened up and people started to get back to normal life and they wanted to really do some massive renovations and not just landscaping around their house, it required everyone to buy building materials and commodities at the same time, which has driven the price of commodities through the roof at a drastic rate. I think the lumber prices are up almost 300%. Steel, oil, all of these things are required to make this stuff happen because you want to power the machinery, you want to build houses, you want to do all of these things that require the growth of a infrastructure or the actual physical area of a city or a house. Then you need to have lumber, you need to have steel, and you need to have gas and electricity to do these things. And so these are all commodities. And this is why these areas are starting to boom and likely why money has flowed out of the innovation stocks into commodities. Because while innovation was booming, because people were stuck at home and people were just researching and developing and creating new products to combat the situation that was going on in 2020, all of those companies were growing and growing and growing. And then once we realized that we were going to be able to open life back up again, and we were going to be able to start building and producing again, the people who were investing a ton of money in these innovation stocks saw that the opening was a signal that we were going to be purchasing massive amounts of lumber and steel and oil and things like that. So they switched all the money from the innovation stocks into the commodity stocks and basically rode those up. However, if this wasn't a 2020 and 2021 situation, the stability of commodities in most times is pretty great for your stocks, and that is really where a lot of people put their money in order to prevent losing value or, taking a chance on Bitcoin or something like that, because that technically is another currency that you can buy. However, we all know that Bitcoin and Dogecoin have a little bit of volatility in those currencies as well. Now, there are two other ways that we've talked about at the beginning of this video that you could make a profit on the downturn of an economy or downturn in the stock market. Number one is shorting a stock. And with shorting a stock, that means you are selling the stock now in order to buy it in the future. Now, how that works is that you can go on, I know that you can do this on E-Trade. I'm not sure about Webull or pretty sure you can do it on Robinhood, but I know for a fact that you can do it on E-Trade. And with E-Trade, you buy a short position, and you are basically betting that the stock is going to go down. Because what that means is you are selling the stock now and buying it later. Now, you might understand, or I would think you guys are smart, you definitely understand this. So you sell the stock now and you're buying it in the future. That means that you have a infinite area of loss in this department, because a stock can go down to zero, and then that can be the most that you can make on that stock. However, if the stock goes up, there is no limit to how high a stock can go up. So you have an infinite amount of loss in this area if you choose to short a stock, because when you're shorting a stock, like I said, you are selling it now to buy it in the future at a discounted rate. So whenever you get a short position, you are selling it now to buy it later. I think if I've said it now 4 times, hopefully it makes sense. But so whenever you reach the end of where you think this option is going, or wherever you think the short is going to end, you then buy back in or cover that position. So you either wait until, because just like now, all of our losses and gains aren't realized. The same way, unless you cover that position, you aren't going to have to realize the potential profit or loss of shorting a stock. So this is really where, it's a little bit hairy, because it is a risky move to take short positions in a stock market downturn, because you don't know how long the downturn is going to last. Right now, we're in the middle of a downturn, hopefully getting towards the end of a downturn, and we don't know if we choose to short a stock now, while it may work for the next few days, we could hit the bottom in the next day or so, and then the stock shoots up 40%, and then now as it goes higher and higher and higher and gets back to what its norms are, you're eventually going to get into a position where you are basically owing an infinite amount of money on this stock. So while you can make money on these short positions, and some people do make money shorting these stocks, it generally is not the best idea, because you are at a ultimately infinite amount of risk. There is no, if it goes to zero, you lose all your money. It is if it goes anywhere above where it is now, you can lose infinite amounts of money. So whenever you look into short options, or not short options, but whenever you look into shorting a stock, make sure that you are doing your research and you have counted the cost as to, you can't really count the cost if it's infinite, but understand that you're getting into a situation where you could potentially be in a really bad situation. So anyway, let's move on to options now. Options, whenever we talk about the option buying or selling options, you are literally buying a contract to buy or sell a stock at a certain price. So in this situation, we're talking about buying options in a downturn market. So you could say buy a option for, let's say, Hyliion with a strike price of 7. That means that you are buying an option to buy or sell Hyliion if you're buying a call option. No, it's a put option. A put option is to sell the stock. So whenever you buy a call or put option for Hyliion with a strike price of 7, you are basically creating an insurance policy for yourself. You are writing a contract that says no matter where Hyliion goes down, you are going to be able to sell at $7 per share. So if you buy that if you purchase that contract, you see Hyliion go down to $5, you are able to sell at $7 even if it's at $5. Now, options get a little bit tricky because you can either trade the option because you are basically selling someone the contract themselves to buy or to sell at 7 whenever it's worth 5, and then you trade and transfer the ownership of that contract to someone else, or you can choose to exercise that option and then make the purchase yourself and buy the stock at 7 whenever it's trading for 5. Now, like I said, this is mostly a insurance policy for a stock going down. This is great because you don't have to take on that much risk. However, it does get a little complicated whenever you are getting into lengths of time because, people say YOLO call options or YOLO put options. You're basically saying that you are betting on an amount of time, and the amount of time within an option is really a term of value for this option as well, because whenever someone buys a contract with a shorter amount of time for expiration, so let's say you have a 3-week option, the 3-week option means that there are 3 weeks for volatility within that option to do price fluctuation. So if the strike price is at 7 and you think that stock is going to go down to 4, but it's only 3 weeks, you only have 3 weeks for it to get a $3 drop in stock price. Now, that makes it a bit more valuable, and in some people's opinion, but if it all happens that way, then it makes it a little bit more valuable, and you have the lack of time as the asset. And then whenever you get into a longer option, like let's say you have a 3-year option, that contract has a higher amount of time. So anyway, if that makes sense at all, you're able to have a little bit more volatility. You can stand for a mistake to happen without having to exercise that call option or the put option whenever the time runs out, because when the time runs out, you have to exercise it, and whoever gets left holding that options contract is the one that has to exercise it. So I hope all of this makes sense, and I hope that you realize above all else that really buy and hold is the best way to go. Yes, you can make money shorting a stock. Yes, you can cover yourself with put options, but really it just doesn't make sense, in my opinion, to trade in and out of stocks, to try and do all this stuff to manage risk during a downturn in a market. It makes more sense, in my opinion, to buy into those stocks that you have a high conviction in, because really whenever you buy into those high conviction stocks, you get a lower price as the market goes down, and if you know the value of that stock and you know the future of that, not you know the future of it, but if you have a high enough level of conviction to say you are willing to buy into this stock even whenever the market is downturning, even whenever it is losing value, you know the potential of this stock and this company, and you get to buy it at a discount. And so, in my opinion, that is really the only way to go if you are a long-term investor, because in this situation, you are going to be giving yourself the best advantage because you are going to be increasing the number of shares you have, as well as driving your average cost basis down. So anyway, in my opinion, the real method here is to just be a buy and hold investor, buy the dips, and buy the market downturn for sure. So anyway, I hope you guys are having a great day, and remember, someone is going to do something amazing every day, guys. Why not you? See ya.